slide, what I want to talk about is what exactly is a temporary interest rate buy down? It can sound kind of complicated, but it really isn't. In fact, it's incredibly simple. So I'm going to try to explain that. With a temporary interest rate buy down, you're going to take whatever the mortgage is that's available at current rates, what I call the market rate, which essentially is what's the best rate available for an FHA or a conventional conforming loan. What's the best rate available for a given credit score at 0 points? And so let's consider that would be the note rate. Right now, as of right now today, conventional conforming mortgage rates are right around mid sixes, let's say 6.5. In December, actually, when we were preparing this program, they were actually dipped down to the sixes, or right around 6. Now, FHA, VA, we're still around 5.75. So let's consider that the note rate. What a buy down does is it provides an ability to subsidize that rate that the borrower is going to undertake, subsidize it for 1 to 3 years. So what does that mean? Well, if you subsidize it for 1 year, that means, let's say if we're starting at 6.5 as the note rate for a 30-year loan, then for the first year, the rate would be subsidized to 5.5. If you did this for a 2-year period, the rate would be subsidized the first year by 2%, 1% the second year. Or if we do 3-year subsidy, then it would be 3% the first year, 2% the second, and 1% the third. So the cost to do this, to buy down that note rate for that 1 to 3 year period, is typically paid by the seller, not the buyer. In fact, most lenders won't let the buyer pay for the buy down. In fact, frankly, anyway, it doesn't make financial sense for the buyer to do that because you're just you'd be providing a good amount of your own money up front to subsidize the payment schedule over the next 3 years or 2 years or 1 year. And that's a diseconomic thing to do. Now, sometimes when the seller cost for the buy down is considered as points, but that's not so. It's technically not points. It's an interest rate subsidy. So that's an important subtlety about temporary buy downs. The cost that the seller incurs is not considered part of the points and fee limits that the Consumer Financial Protection Bureau installed way back in 2010 for the current conforming loan environment. So again, the seller paid cost of the temporary buy down is not technically considered points. And what the seller is simply doing is they're paying the difference in the payment each year based on what that bought down rate is. So they're going to look at the payment the first year, the payment the second year, the payment the third year, compare it to what that note rate payment will be when the subsidy period is over, and then calculate the difference in the monthly payment each year for the period of the rate buy down.